We're going to explore how this massive Fed rate cut is going to affect our 4 favorite stocks here. Each of these companies have a unique position and they are impacted in ways that might surprise you. I know you're eager to learn about how these 4 companies and how we can profit from them. But I also want to make sure you have the tools to really capitalize on the opportunities like this big one here. And that's why I'm hosting our first ever beginner trading challenge. It's a 2-day event. It's just an hour each day at 8 p.m. Eastern time. And that's where I'm going to teach you exactly how we set up trades, how we automate profit taking and risk management, and how we're up 93% so far this year. So all you're going to do is sign up, pop over to felixprehn.org/challenge, grab your free spot and become part of the 1 million people that we want to make financially free here in this community. By the end of this video, you'll have a whole new perspective on how these economic decisions by the Fed shape the future of the most exciting companies in the market. A 50 basis point cut means the Fed has lowered its benchmark interest rates by 0.5 percentage point. A significant move, especially in today's economic climate. To put it in perspective, imagine you're adjusting the temperature in your house. A 25 basis point cut is like turning the thermostat down 1 notch. This 50 basis point cut, it's like cranking it down 2 notches at once. Now, you might be wondering, Felix, how does this compare to previous rate cut cycles? And I'm glad you asked. Let's take a quick trip down memory lane so we are best placed to understand how this is going to affect our favorite tech giants here. Cast your mind back to 2007 and 2008. During the global financial crisis, the Fed slashed rates from 5.25%, which is where we just were, to nearly 0 in just over a year. That was like turning the economic thermostat from scorching to Arctic in record time. More recently, in 2019, we saw 3 quarter-point cuts in response to the global growth concerns. And then, of course, was the pandemic response in 2020, when rates were cut by 150 basis points in 2 emergency moves, bringing us back down to near 0 territory. So compared to these past cycles, this 50 basis point cut is significant, but not unprecedented. It's the Fed's way of saying we see some economic headwinds and we're taking preemptive action. So what does this mean for the economy and the stock market? Well, in general terms, rate cuts are designed to stimulate economic activity. They're like a shot of espresso for the economy. Lower rates make borrowing cheaper, both for businesses and consumers, and that can lead to increased spending and investments. For businesses, it might mean taking out loans to expand operations, hire more staff. And for consumers, it could make mortgages more affordable, that it could encourage them to take out loans for big purchases like cars and so on. The stock market, rate cuts often lead to a boost in stock valuations. Why? Well, when interest rates are low, bonds and saving accounts offer lower returns. And this makes stocks more attractive to investors looking for higher yields. However, and this is crucial, the market's reaction isn't always straightforward. Sometimes a rate cut can be seen as a sign that the economy is weaker than expected, which could actually lead to a market sell-off. It's also worth noting that the effects of a rate cut aren't instantaneous. It's more like planting a seed. It takes time for the effects to fully manifest in the economy. Now, with this context in mind, let's turn our attention to our 4 companies and see how they are going to navigate these changing economic waters. First up, a certain electric car manufacturer that's been making waves. Right then, let's kick things off with Tesla here, the electric vehicle giant that's been electrifying the market for years. Now, how might this rate cut affect Elon Musk's brainchild? Let's break it down. First, let's take a quick trip down memory lane. During the last significant rate cut cycle in 2019 and 2020, Tesla's performance was nothing short of electrifying. There, I said it again. In 2019, as the Fed began its rate cuts, Tesla's stock started gaining momentum. By the end of that year, Tesla has surged from $15, in June to approximately $30 in December. Now, these stock prices are, of course, taking into account the splits we've had since, so they were slightly different back then. But that was just a warm-up. When the pandemic hit in 2020, Tesla stock initially took a hit, dropping to around $30 in March, but then something remarkable. Following the Fed's emergency rate cuts, Tesla stock didn't just recover, it went to Mars. By the end of 2020, it had reached new all-time highs, closing around $250 in December. So how does a rate cut impact Tesla? First, the positives. Lower interest rates could be like a supercharger for Tesla's sales. Why? Well, it all comes down to financing. You see, when interest rates drop, so do the cost of auto loans. Suddenly that Model 3 or Model Y you've been eyeing or the Cybertruck becomes a bit more affordable. It's like the Fed is giving potential Tesla buyers a little nudge towards the checkout counter. But it's not just about selling more cars. Tesla, being the ambitious company it is always looking to expand and innovate. Lower interest rates means cheaper borrowing costs for the company itself, and that could fuel Tesla's relentless drive for expansion and R&D. Imagine more gigafactories popping up around the globe, increased investment in battery technology, autonomous driving, faster iteration of their own AI technology. It's like giving Elon Musk a discount on his grand plan for the future. And let's not forget about the stock valuation. In a low interest rate environment, growth stocks like Tesla often become more attractive to investors. Why? Because future earnings become more valuable in present terms. Confusing, but it's a bit like planting a tree. The lower the interest rate, the more valuable that future shade becomes. But it's not all sunshine. Tesla faces some challenges in this new economic landscape. First, Tesla's products are still considered luxury items, although I think they're becoming a lot more mass market, which is a good thing, by the way. But at the moment, they are what economists call discretionary purchases. In simple terms, they're things people buy when they're feeling flush, not when they're pinching pennies. And if the Fed's rate cut is a response to underlying economic weakness, consumers might tighten their belts, regardless of cheaper financing. And I know the Fed is saying we're cutting rates because the economy is really strong, but that's a little bit like saying war is peace. There is also the potential for supply chain pressures if the economy overheats. A sudden surge in demand could strain Tesla's capabilities and capacities and drive up input costs. It's a delicate balance. But despite these challenges, I'm optimistic about Tesla's position. Why? 2 words: financial resilience. Despite the headlines or Wall Street often complains about it, Tesla has been posting strong gross margins, indeed outperforming traditional car makers. And that gives them a cushion to absorb economic shocks or fluctuations in demand. It's like having a thick layer of bubble wrap around your business model. It helps to soften the impact of any bumps, which sort of bounce back up. And Tesla has been consistently generating positive free cash flow in recent years. And that means they're not only making money, but they're retaining enough to fund their operations and growth without relying heavily on external financing. In essence, Tesla has built itself a financial fortress, and this strong financial position could allow them to weather whatever storms are coming our way. Now then, let's turn our attention to a company that's quite different from Tesla, but no less intriguing. Palantir Technologies. During the 2019-2020 rate cuts, Palantir was still a private company, going public only in September 2020. Since then, they've been on quite a journey. Now let's consider how this new rate cut will impact Palantir. First, the positives. Palantir has been expanding its reach beyond traditional government contracts. They're gaining more and more commercial clients, with their total addressable market expected to exceed a staggering $800 billion by 2025. So exciting, my cat's just meowing at me. This one here. This is Tallulah, who's of course responsible for all the research around here. And this diversification into the private sector is crucial. While government contracts provide stability, the commercial sector offers tremendous growth potential for Palantir. A rate cut could accelerate this trend in 2 ways. First, lower interest rates might encourage businesses to invest more in the AI digital transformation. Palantir's data analytics solution could be exactly what these companies need to gain a competitive edge and maybe save some costs. And secondly, cheaper capital could allow Palantir to invest more aggressively to tailoring their products for commercial use. Although, given that Palantir is sitting on a pile of cash, I don't think that really matters as much. So what's the downside here? Well, Palantir doesn't really directly benefit from increased consumer spending. That often follows a rate cut. Their sales cycles are typically longer and more complex and at the higher level of companies. But here is where Palantir's unique position shines through. Their diverse client base across government and commercial sectors provides a form of economic hedge. If one sector slows down, the other might pick up the slack. Moreover, Palantir boasts impressively high gross margins exceeding 70%, and that financial strength combined with their free cash flow gives them the flexibility to basically pursue growth opportunities regardless of what the heck's going on out there in the economy. So while the rate cut impacts Palantir, it might be less direct because they're not consumer facing. But from a valuation point of view, I think lower rates will benefit Palantir tremendously. It's still perceived as a risky investment. And these kind of risky investments are usually shunned when interest rates are high, because if you can get 5% from Uncle Sam with zero risk, allegedly, then why the heck would you bother with something that's got a high risk? And when interest rates are low, that money still chases returns, so some of that ends up in these growth stocks. But now third, let's turn our attention to a company that's right at the intersection of finance and tech. SoFi. Before we dive into how this rate cut might affect SoFi, let's take a quick look at how they fared during the last significant rate cut cycle. During the 2019 and 2020 rate cuts, SoFi was a private company. In fact, they didn't go public until January 2021 through a SPAC merger. So we don't have public stock performance to look at, but we can examine how the business fared. Despite the challenging economic environment, SoFi saw significant growth during this period. They expanded their product offerings, they grew their user base, and even acquired Galileo, a payment processing platform, in April 2020. The low interest rate environment actually helped SoFi by increasing demand for refinancing, especially in student loans. Now let's consider how this new jumbo rate cut might impact SoFi. First, the positives. Lower interest rates could be a boon for SoFi's lending business. Why? Well, it's all about demand. When interest rates drop, borrowing becomes more attractive. This could lead to increased loan demand across SoFi's products, personal loans, student loan, refinancing. And that one's important because if you're paying X% on a student loan and now interest rates become 1% lower, which I think there will be the end of the year, you're not going to want to pay that percent still, right? So you're going to go to SoFi, you're going to refinance at 1% lower, and their mortgage business in addition might also benefit. Moreover, lower rates often stimulate the economy, which could lead to higher transaction volumes across SoFi's platforms. More spending, more investing, more financial activity in general, all of this could benefit SoFi. But there is always a but, isn't there? One of the main challenges they might face is compression of net interest margins. Compression of what, you ask? Well, you see, while lower rates might increase loan demand, they also mean SoFi earns less on the difference between what they pay for deposits, the interest you receive, and what they charge for loans. It's that difference where a bank traditionally makes its money. It's a bit like a sandwich shop that suddenly has to pay more for bread while charging less for whatever is in between the bread. However, I remain optimistic about SoFi's prospects. I tell you why. Diversification and digitalization, the D words. SoFi has evolved from a student loan refinancing company to a fully fledged financial services platform. They offer banking, investing, credit cards, financial education, the whole lot. And that diversity provides stability. If one area of the business faces headwinds, like student loans have done the last 4 years, other areas pick up the slack. And their digital-first approach positions them well for the changing consumer behaviors. As more people embrace online and mobile banking, and maybe you think everybody is using it, they're not, but it's growing, SoFi is right there, ready to serve them. And let's not forget about SoFi's improving financials. They've been consistently growing their member base and revenue. In the last quarter, they reported a 41% year-over-year increase in members and a 38% increase in net revenue. So while the rate cut presents opportunities and some challenges for SoFi, I think they're in a very, very strong position to benefit from this. And then, of course, the same what I said above, Growth stocks benefit from lower rates in terms of valuation multiples, which expand, applies also to SoFi. If you look at a chart of the fintech sector, type in any ETF like a FinX or something like that, and you see the whole sector has just been getting clobbered to death like a baby seal, and that should end as rates start to come down meaningfully. Now, fourth, let's shift our focus to a company that's been a pioneer in the world of digital payments. PayPal, also known as PayPal these last few years, but people are starting to smile again when they hear the word PayPal because the stock is recovering quite nicely. So let's take a quick look at how they fared during the last significant rate cut cycle. During 2019, as the Fed began its rate cuts, PayPal stock showed steady growth, rising from around $84 in January to about $108 by December. But that was just the warm-up act. When the pandemic hit in 2020, PayPal stock initially took a hit, dropping to about 85 during the March market sell-off. But then something remarkable happened. As the Fed slashed rates to near zero, PayPal didn't just recover well, it exploded. By December that year, PayPal had surged to $234, more than doubling from its March lows. Now let's consider how this new rate cut might impact PayPal this time. First, the positives. Lower interest rates often lead to increased consumer spending, which is music to PayPal's ears. That's how they make money. You see, more spending means more transactions, and more transactions means more revenue and profits for PayPal. PayPal is basically a toll booth on the highway of digital commerce. The more traffic, the more tolls collected. Moreover, as consumer spending increases, we could see potential growth in PayPal's merchant services. More businesses might sign up to PayPal to capture this increased spending, expanding PayPal's reach even further. There must be a downside though somewhere, right? Yes, there is a but, there always is. And this one, well, you could flip the coin and say the exposure to consumer spending is also a risk. If the economy slows down and we don't believe Papa Powell saying the economy is great, that's why we're doing this big rate cut, which kind of makes no sense, then, well, consumers might tighten their belts. You might see fewer transactions. It's a bit like PayPal is on a ship on the sea of consumer spending. When the sea is rough, the sailing gets a little tougher. However, I'm optimistic. Why am I optimistic? Well, cash flow, resilience, and better management. PayPal has very strong free cash flow. They reported $6.7 billion in free cash flow in the last quarter. That's for the year. And that strength gives them tremendous flexibility to basically survive pretty much anything. They also boast pretty high margins, a global presence. They're the dominant provider in e-commerce. And therefore, PayPal is very, very hard to replace. Now, talking of management, we're seeing a lot of innovation, a lot of partnerships, a lot of slashing of costs. And that's, of course, exactly why the stock is peaking up. It isn't just the rate cuts. They've been expanding into cryptocurrencies, buy now, pay later. They are expanding strategic partnerships and dipping their toes into the advertising business, which I think could be tremendously profitable. I think it could outgrow the existing businesses. And that brings in new revenue streams, more opportunities, more growth. And that's what the market's been missing. The market's been looking at PayPal and going, these guys ain't growing anymore. And therefore, the stock price tanks because the stock market is forward looking. It doesn't really care that you have $6.7 billion in free cash flow if you can't show the market how it's going to be 7 or 7.5 next year. The market's a bit like a junkie. The last hit was nice, but the next hit better be bigger. PayPal is now back on the path to becoming that junkie. So let's rank these companies on their potential benefit from these rate cuts. Now, past performance, of course, doesn't guarantee future results, but I think it can give us some valuable insights. In my view, the ranking from most to least potential benefit would be 1 Tesla, 2 SoFi, 3 PayPal, and 4 Palantir. This is the benefit from rate cuts in that order. Tesla takes the top spot because lower interest rates could significantly boost demand because people don't buy cars anymore. People finance car purchases. They lease them essentially. So the question is not, is that car $25,000, but is that car $700 a month or $500 a month? The lower it gets, the more people will buy. SoFi comes in second because as a fintech company focused on lending, they stand to benefit from increased loan demand and refinancing particularly. And PayPal takes the third spot because they might see a boost from increased consumer spending. Palantir fourth, well, because the link to software spending isn't quite as direct. Because they have their own cash flow and they don't need to borrow and they don't tend to do acquisitions, the impact there is a little bit lower, and it basically comes in mostly in the form of the stock price valuation. Multiples get higher when interest rates are lower. But what about resilience to shocks? What if something bad were to happen? Well, let's rank them in terms of resilience. Number one, most resilient of these four stocks, I would rank Palantir. At number two, I would rank PayPal. At 3, Tesla, and at 4, SoFi. Palantir takes the top spot here because their long-term government contracts and expanding commercial client base provide stable revenue, recurring revenue even in tough times. PayPal comes in second because their strong free cash flow, over $6 billion, the high margins and global presence gives them a lot of flexibility. Tesla comes in third because yeah, they have good margins, they have good cash flow, but they're a lot more exposed to consumer discretionary spending. People don't buy cars when they feel bad stuff's about to happen. They can delay it by a year. SoFi rounds out the list because even though it's a diverse company, they are the most exposed to potential credit risks. And I know their user base is pretty high income, so they're not that directly affected. But if something really bad were to happen, they're going to get clobbered with everybody else in the fintech space no matter what, because people don't read the fine print. Now, you might be thinking, Felix, why the difference in ranking? Well, it's a bit like comparing apples and oranges. Benefits from a rate cut and being resilient to economic shocks are two very, very different things. A company might be well positioned to capitalize on lower interest rates, but that doesn't necessarily mean they're equipped to handle a severe economic downturn. Though, do I think we're going to get a severe economic downturn? No, I don't. And I tell you why. I think the Muppets that run the US are going to spend to make themselves more popular. That's the likely outcome. Now, of course, if Trump comes in, he's going to cut lots of taxes, which is sort of the same thing. So what should we do? Well, I think diversification is probably the least popular word I could throw in here, but it is important, and I therefore throw it in regardless. It's important to build out a portfolio that survives different economic scenarios. There's a reason I own tons of Philip Morris stock, for example, not because I think it's going to double by next year, but I know the smokers and the addicts will still be addicts in times of economic peril. So if you want to turn this year and the coming year into the best year for you, well, get started with us and learn how we're up 93% so far in our teaching portfolio. I'm not promising you those results, but I'm promising to show you how we do it. We're hosting our first ever 2-day beginner trading challenge. About an hour each day at 8 p.m. Eastern time, I'll show you exactly how we do what we do. And you don't need to know a thing. It's completely free of charge. All you got to do is grab yourself a free seat at felixfriends.org/challenge and show up on time. I hope this video has given you some insights into what's going on with our most popular stocks. If it has, share it with a friend, smash the you-know-what, and I hope to see you on Tuesday at felixfriends.org/challenge. All the best. Winston and Felix here, and I just got this morning a note from the senior trader at Goldman Sachs, one of the world's greatest investment bank. If greatest is a word one should attribute to banks, that's our conversation. And you know what?